Disruption is always a fear of technology investors. For good reasons. The radio gave way to televisions, landlines to cell phones, and flip phones to smartphones. Is Google Search's ad business about to disappear? Now chatbots using artificial intelligence, they are beginning to shake up the internet search, a field dominated by Google, according to Melius Research analyst Ben. The disruption could make Alphabet stock this generation's Kodak. Alphabet is down 25% from recent highs and is still cheap for a reason. Remember Eastman Kodak? Most investors would prefer to forget it. Kodak and its dominated photography until the development of digital cameras. The company filed for bankruptcy protection in 2012 and emerged in 2013. Its market value today is about $500 million, compared with about $30 billion at the peak in 1997. At the time, annual sales totaled roughly $16 billion, with operating profit approaching $2 billion. Sales in 2024 amounted to $1 billion, with no operating profit. Google is at risk of losing the status as an almost universally accepted search tool that underpins the verb Google. Ben said, "How many kids say they'll Gemini their research paper?" He asked. Kids make ChatGPT their home screen and just use it to find answers with no noise from annoying ads. So far, the data don't show a deterioration in Google's search business. That won't materialize until 2026. In a sense, Alphabet is already disrupting itself, moving away from ads to subscription. Supported sales of its own AI business tools. There are more than 100 million Google One subscribers. And while Gemini isn't a verb yet, more than 1 billion global users said Gemini AI summaries every month that dwarfs the numbers AI startups have achieved. The scenario Kodak might not be on the table, but Ben makes one more point that matters. Fear of disruption can hurt stock valuations for a long time. Kodak peaked at nearly a 20 times next 12-month PE multiple in 1998 and was a sub-7 times next 12-month EPS 3 years later. While Alphabet's multiple has already declined about 40% from its peak in 2020, its 18 times multiple today, called cheap by most analysts, is roughly the same as it was on the day of ChatGPT's launch in 2022. As AI chatbot competition heats up, investors might be unable to rely on a rising price-earnings ratio to boost Alphabet shares. Gains will have to come from earnings growth, capital returns, and smart strategic decisions. Investors will have a chance to evaluate how things are going next week. Google Cloud 2025, Alphabet's Developers Conference, starts on April 9th. Analyst is looking for details on AI and Alphabet's recent purchase of the cybersecurity platform Wiz. The average analyst price target for Alphabet shares is about $217, which values the company at about 24 times estimated 2025 earnings. Its current valuation is closer to 17 times. I recently bought back my Google shares because I think they are a leader in AI and quantum AI. What do you think about Google stock? Do you think it's a value trap? If you do, check out the Trade Desk. In my opinion, it will be a much better moneymaker in the future than its competition, Google. This is why. The Trade Desk was one of the market's hottest digital advertising stocks. It went public at a split-adjusted price of $1.8 per share on September 21st, 2016, and it rallied more than 6,000% to a record closing price of $139.51 on December 4th, 2024. A $20,000 investment in its IPO would be worth $1.24 million today. But today, the Trade Desk stock trades at around $57. It lost more than half of its value as investors fretted over its slowing top-line growth. So what is the Trade Desk exactly? The Trade Desk owns the world's largest independent demand-side platform for digital ads. DSPs sell advertising space for programmatic ads across desktop, mobile, and connected TV platforms to advertisers. They work in tandem with sell-side platforms, which help publishers sell their own ad inventories. Bigger tech companies like Alphabet's Google and Meta Platforms bundle together DSPs, SSPs, and other tools in their own digital advertising platforms, but they generally lock advertisers and publishers into their websites, apps, and advertising networks to break free of those walled gardens and reach the broader range of platforms across the open internet. Many of those companies turn to independent DSPs. Instead of going toe-to-toe with Google or Meta in the mobile and PC markets, the Trade Desk is expanding its CTV business through ad-supported streaming video services to help advertisers deal with tightening restrictions for collecting third-party data. It provides Solimar, an AI-powered platform that collects more first-party data in its unified ID 2.0 solution that replaces traditional cookies. It also has been building its own OS for smart TVs called Ventura to host its own ads. Furthermore, it's been bypassing SSPs like Magnite and Google's Ad Exchange with OpenPath, a platform that directly links publishers to advertisers. All of those efforts could transform it into a more broadly diversified advertising company. Is the Trade Desk pullback a buying opportunity? That pullback reduced the Trade Desk enterprise value at $26.1 billion, or 9 times this year's revenue. Those valuations are reasonable relative to its growth rates, but its upside could remain limited as long as the macro headwinds throttle the expansion of advertising sector. So if you plan to hold the Trade Desk stock for at least a few years instead of a few months, it's a great time to accumulate some shares as the bulls look the other way. If you're worried you've already missed your chance to invest, now is the best time to buy before it's too late, and the numbers speak for themselves. Nvidia, if you invested $1,000 when we doubled down in 2009, you'd have $280,000. Apple, if you invested $1,000 when we doubled down in 2008, you'd have $42,000. Netflix, if you invested $1,000 when we doubled down in 2004, you'd have $503,000. Are you audacious or not? Let me know.